keeping a really close eye on it, because I think there could be some absolute bargains if there's a real sort of like a March 20 when the first kind of downdraft, you're like, oh, okay, this stuff is cheap, and then you get the real like just crazy liquidity and everyone freaking out, and that's where you see those sort of opportunities don't come around very often. And so the way I read it is the world slowly realizing that no one's going to buy the US debt, and so they're going to inflate it away, and everyone's just grabbing everything. They won't get inflated. Like you see you've seen it in just the unwillingness to buy US treasuries for years now, and I feel like that's kind of accelerating at the same time that US has to roll 8 trillion and issue another 2 trillion. If you understand, if you're going to have really high outperformance, then you have to be in that few percent that can cold-heartedly open your portfolio, see a stock's down 70% and be like, that's still great value. I'm going to buy that now.
Hello, guys. Welcome to Capital Cosm. Today, I have a special returning guest. It is Trader Ferg. It's always a pleasure to have Trader Ferg. Ferg, thank you for coming back on the show for a third time.
Brilliant to be here. Thanks for having me back on.
100%. As always, nothing to do with financial advice. Neither Trader Ferg nor I are financial advisors, so please do your own due diligence. All right, Trader Ferg, I think everyone pretty much knows who you are. If this is your first time hearing about Trader Ferg, we've done 2 other interviews prior. Go ahead, if you haven't seen his work yet, from an introductory sense, I highly suggest you check out those 2 interviews. But we're going to just dive right into it. Let's go ahead and take your view on the current state of the markets at the moment. You know, you've got Bitcoin and gold making new all-time highs pretty much on a weekly basis now. Oil's sitting at $82 last time I checked. What's going on? What's your just very macro view of the market?
Oh, macro view of the market at the moment, I feel like one of the first things that my mentor taught me was to always look out for narrow markets, and I've always kind of kept that in mind, like the idea of narrow versus broad markets. And I think this is like the absolute, this is the clearest example of that I've come across in my sort of 8 years of trading now. Is we're seeing the market just get increasingly narrow in the US with what started off as Mag 7, Mag 6, Mag 5, Mag 4, and now it's just getting really held up by Nvidia at this point, and even that's starting to look a bit shaky. And that's like the clearest way to explain that is just like being careful around narrow markets. Is just like the simplest analogy, I guess, would be like a theatre. Like once it gets packed to the walls and everyone's just in 1 or 2 names, like that's just like one doorway to get out, and you've got everyone so stacked in the theatre. Like if anyone shouts fire, the results are quite predictable. And the other side of that is where you should feel safest, is like broad performance. And with that at the moment, you could be talking any of the sort of, if you look at the equal weighted performance of most sort of developing market indices, are actually beating the US now, which is kind of fascinating considering how much focus just the outperformance of the US is getting. And that analogy is this is just a few people in the front row and there's plenty of doors. So there's no sort of real selling pressure. And that's what I'm just watching. I'm just watching the sucking sound. There's more and more capital is getting pulled in to this whole AI sort of dominant market narrative. And everyone's ignoring everything that's outside that narrative, and also outside the sort of passive flows. Like it's quite interesting when anyone asks, like, okay, I understand that, but how do I really avoid this sort of narrow market? And it's actually quite difficult, even if you like just tell someone to jump in like one of the international, like Vanguard Vanguard World or something, still sort of very heavily like 60% weighted towards the US, and then of that 60%, you're obviously stuffed to the brim with the Mag 7. And so ultimately, you're always kind of getting these massive companies snuck into your portfolio. And I just think that's such a massive danger at the moment, because you can go through all the different layers. You can question like the the essentially can AI live up to the growth
Yeah, it's
forecasts?
a single point of failure for the market.
Yeah, yeah, 100%. And it's just the way the market works. Is there's always like there's multiples just get pushed to the point of failure. Like there's just all a multiple is enthusiasm for a sector and a stock, and you're just saying how much you pay for it. And there's a point at which it just can't live up to it. And so when I looked at Nvidia a few months ago, it was already like forward multiples was saying that it would have to grow 100% in the next 5 years. And since then it's kept going up and up and up. And so there'll be a point, even if the business does really well, like we saw it with Cisco back in 2000, everything they said in their sort of projections and their commentary was like, we'll grow the business at double digits, we'll be the backbone of the internet, we'll keep growing revenues consistently. They did all of it, and the stock fell like 80, 86, 87% from the peak. And that was just because of people decided the future didn't deserve that multiple, and so the stock got crushed. And I see a similar thing happening, and if anything, I'm probably more negative, because I just think not only is the AI trend so overextended, I see the US trend overextended versus the world. I see the passive trend overextended. Not to say it can't go for quite a while. Like I've learned that lesson with Tesla multiple times, was sort of thought the writing was on the wall and got punched in the face when it exploded higher. But I think when this rolls over, it's going to be fascinating, because a lot of the sort of passive flows have been pushed into these stocks and have driven them to nosebleed levels. And I really don't know who buys them. Like the passive's over sort of 50% in the US, and the active side has just been crushed. It's just had outflows for years now. And you better be sure they're not going to be jumping on the Mag 7 when they sort of have their first big drawdown. They'll be in what's working. They'll be in what's causing the rebalance, or saying like, yeah, that they'll be savvy enough for those that have survived to sort of say, I want out of the way. And those that aren't savvy enough will be up to their eyeballs, and they'll be selling the stuff as well. So it's going to be this hellish reflexive loop that I see coming. And that's why I love just hunting for stuff that's well outside the anything that's been touched by those passive flows. And so this just leads me in all sorts of corners of the world that kind of off everyone's radar, and any stuff that is kind of could be affected by the flows. I'm keeping a really close eye on it, because I think there could be some absolute bargains if there's a real sort of like a March 20, when the first kind of downdraft, you're like, oh, okay, this stuff is cheap. And then you get the real, like, just crazy liquidity and everyone freaking out. And that's where you see those sort of opportunities don't come around very often. And so if you can have your eye on a few positions there to jump on those, that's a fantastic opportunity. And so, yeah, coming back to asking what am I seeing that big narrative roll along, and I think it's going to end badly. And the other one is just everything quietly outperforming that no one's paying attention to. And so just continue sorting through that and trying to find the best opportunities that have a really long runway.
Yeah. So one of the things that's going on now is that you've got a lot of capital inflow into crypto. Crypto is usually a signal for liquidity, right?
Yep.
So you've got AI that uses a ton of energy. You've got crypto that also uses a ton of energy. So it kind of begs the question, where's all this energy going to come from, right? And that's where you and I come in with our energy stocks, our commodity stocks, and so forth. So is there anything that you see that's more, that you would say is more, you're more bullish on than commodities and energy right now, or not? What's your take there?
Well, judging by my portfolio, no. No, I don't really have. I am really coming around to the gold thesis. I'll say that. I think when I first, I've made arguments before about oil heavily outperforming gold over the long run, there was an inherent assumption that the paper market would stay intact. And so I'm kind of starting to rethink that with the way there's just this constant premium with Shanghai over London, and they're just it's pretty simple really. They're just hoovering up all the physical gold. It's just that cartoon of the West throwing gold over a fence and the Chinese throwing cash back, and I think this keeps going till something breaks in the West with the finances, and that's really got me rethinking my position on gold. Because if that's quite clear, which it is, if you just see this premium persist, like all arbitrages will get sort of taken advantage of over time, and there is a purpose to it as well. With starting to use gold as settlement, it's not going away. And once you understand that the paper gold market is going to get taken out, then it can no longer be managed how it has been. Because gold's been sort of a political metal for a long time now. Like no one can tell you how much paper gold is actually out there. And so once that goes and there's actually proper supply demand of gold, then that gets pretty interesting. So I'm enjoying seeing that also with some of the sort of the super negative sentiment in gold. So yeah, that's something I'm doing a lot of work on at the moment, trying to work out how to position for that, because that's where my portfolio is really lacking. And I'm see a massive energy bull over the long term, whether it's coal, whether it's uranium, whether it's oil, and sort of oil derivatives as well, whether it's shipping, whether it's offshore drillers. I love all of it, and all of it's just it's all out of the sort of indexes. It's all out of it's been out of sort of the flows. I've got this chart that I love to show that every quarter, forget which bank, just shows it, and it's just monthly flows into sectors, and it's just pretty much one line of just all the flows into tech, and then the bottom is always energy. So it's just this hoovering sound of capital flowing out of energy and tech and everything but tech essentially, and just being pulled in. And it's fascinating to see. Tech doesn't need the money either. Like what are they just doing? Like all the big names are just sitting on massive cash piles and buying back the stock. Like it's not causing any innovation. And I just see it as a massive opportunity, and I can't get enough of hard cash flowing assets. That's where I'm just up to my eyeballs at the moment.
Yeah. So you mentioned that you've been underweight gold a bit, and you're looking to kind of enter it there. So is silver in your calculus as well, given its close correlation to the gold price? Like how are you figuring in, like, number one, discerning between the physical gold price and then, or investing in the gold miners, or investing in silver, or investing in the silver miners. So you've got multiple ways to kind of skin this cat. What's kind of been your take there?
Yeah, well, I'm still very early in this. I actually haven't really got any real position to it, but silver's obviously a lot. Silver's like probably the better way to play it if it's just going to stick a toe in the door. So that was the first way I was looking at it. Is I think silver probably outperforms gold, and just more volatile, smaller market, has got some sort of industrial uses. And yeah, it's just a hard thing with all of these. I hate going into miners. I like it sort of a cleaner play, but probably end up having to go into miners and have some exposure. I don't really like the straight ETFs at all. Kind of on the clearer ways, because if this thesis does play through and there is a serious revaluation due to the paper market being taken out, you're talking like it would be a large move in gold, and that would drag that would put a whole lot of the miners that had a higher cost base well in the money, and so you can kind of view them as more out of the money call options, and kind of see the same playing out with silver. So that's kind of how I'm approaching it at the moment. It's still early days, and I haven't really built a position. I was kind of hoping for the first slices I have. I'll take off my uranium portfolio if that keeps going the way it's been going to be sort of allocated to this. If I see this as the best sort of use of that first bit of money, I've got lots of ideas on the shelf at the moment for where that rebalancing will start to happen. It's constantly reweighting them in my head, like what's the most attractive.
Yeah. So,
And
what are
for
some
me,
metrics that you use? Do you look at ratios? Or like, what exactly do you use to determine how to rebalance?
I just have very clear exit plans. So I've written how I would exit uranium for a few. It's one of my first, not maybe first, one of the first blog posts I did on. I had an old blog, Trader Ferg, that I set up in COVID and started writing, and
Monkey
it
trap?
was maybe, yeah, monkey trap,
Yeah.
yeah, like that. And that was just showing people how you got to be extremely careful when going into a cyclical sector, because the worst thing you can do is get caught up in the narrative. And like, for anyone that hasn't heard of a monkey trap, it's just the idea of like hunting a monkey. You can do it with a coconut that you hollow out, and you have attached the coconut to a tree with a bit of rope, and then you have a hole in the coconut that's just large enough for the monkey to stick its hand in. And you put a whole lot of nuts in the coconut, and so what happens is the monkey sticks its hand in the coconut, tries to grab all the nuts, and of course can't pull its hand out with all the nuts in it, and the hunter can just walk up and grab the monkey, and the monkey could of course escape if it would maybe just take one nut, like release the majority of the nuts. But the monkey's own greed means he gets killed. And so I use that as an analogy for not being prepared to leave any gains on the table means you'll get killed in a highly cyclical bull market. And so you've always got to accept the fact that you're going to get out early. It's going to be painful as you're going to watch the thing probably do some silly blow off top, and you can have a tiny bit still on the table, but an ideal scenario, you would have taken sort of 90% at least of your money off the table in increments when you've seen certain signs in the market. So I have like a whole lot of sort of market signals, and then I have a whole lot of behavioral signals that help. Like market signals are sort of taking 5% wax off everyone I see, and then the behavioral is another 5% every time like some of them are like the taxi driver you see trading uranium. That would be a really late cycle behavioral signal to take another big chunk off. And yeah, that's like super important not to get wedded to a cyclical sector, because that's how there's thousands of people after bull markets that were paper millionaires at some point, but they never managed to realize their gains. And realizing the gains is the real win. And I think people forget how easy it is to get caught up in a narrative. Like everything is so easy to rationalize. All research that gets put out is sort of rationalizing the share price. So like demand projections will keep lifting to make the deficit last, and it's that whole thing of keep pumping to justify. And so it's easier to get caught up in that, and that's why everything I go into, I've kind of got an idea how to get out with a lot of the more hard assets, be it drill ships, VLCCs, OSVs, jackups, all of it. You can have it based on new build prices, the ability to deliver them. Once you see a certain amount of new builds get in the system and know when their delivery is coming on, then that's kind of clear cut how to exit that sector. The likes of coal is a lot more difficult, but you could still see that it would essentially be having to be more sane energy policy would probably get me bearish on coal over a long enough period, like a lot of nukes coming on, and sort of backing away from a lot of these 50% renewables by 2050. If there was more sane energy policy, then I wouldn't be as bullish on the likes of thermal coal. So yeah, it's just having a very clear exit plan when you go into a cyclical sector, so you don't get wedded to the sector and end up riding it up and over the top.
Yeah. So have you exited any commodities yet? And just, I mean, full disclaimer, just because you exit something doesn't mean you're bearish on it. It just means you found better opportunities elsewhere as well. So, is there anything that you've already exited, and why?
No, not really. No, no. This is the short answer. I haven't really sold any of my uranium. Still, that was my earliest position. I did exit some tankers, but that was more because I ran away my tails between my legs after getting my ass handed to me in sort of early 2020. Sort of just concentrating on the fundamentals of the stocks, not understanding that the world was going to lock down. There was going to be no no air travel. That wasn't part of my thesis, and so yeah, took a good bashing there. Trying to, it's one of the faults of my whole philosophy is I often hang on too long, and so that's why I put so much weight on position sizing. Is the fact I know I'm I know I can stick my head in the sand, and it benefits me when I've got good conviction in a sector, and I just need to be patient. That benefits me, but doesn't benefit me if I'm failing to recognize there's been a serious like game changing event, and like COVID was. I didn't have enough imagination that the world could lock down for that period, and that all flights could stop, and so that was painful. I think I took like 30-40% bath on Scorpio at the time, and yeah, another few product tankers. So yeah, that would be the one sector I ran away from with my tail between my legs. Yeah, and I'm back in it now. Yeah, that's the other thing. I often, when I take a bath, I've had to learn. Sometimes it was the thesis was still intact, and you just have to suck up the fact that been really beaten around the ears by it. Like an example was held some offshore drillers into sort of bankruptcy cycle and got obviously zeroed on that. Held Saipem and they recapped and got absolutely zeroed in on that, and just had to suck it up and buy them again when they relisted. So it's always painful. Something that's lost your money, you've got PTSD when you see the ticker. You're like, and even I joke in my portfolio, I've got a little graveyard when they issue the like the 2% equity. Often afterwards, and you kind of can't get rid of it, and it sits there in the corner like a liquid, and it just reminds you that you've made mistakes. Yeah.
Yeah. Yeah. So you mentioned position sizing as a way to kind of protect yourself. Are there any rules that you kind of employ upon yourself in terms of how much you position size? One of the things that I've learned from, Chris and Brad's newsletter, Capitalist Exploits. I know Brad is your mentor there. We're affiliates with them. We link to their newsletters down below, by the way, for those interested. But one of the things that they taught me was just to, position size as a means to protect yourself against the downside. So if you've got a bunch of positions, not over 20%, 30% on a single holding, then you can sleep at night. You can be more psychologically positive about your investment and so forth. So is that something you employ as well?
Yeah, yes, certainly. So Brad was the original one that taught me the importance of position sizing, even though we actually differ a lot these days. Like I like to have fewer positions than Brad, so I do push harder because the way I see it, like it's quite obvious the fact that you can limit your downside by having small position size. So there's no one that'll debate that. A 1% position, 2% position isn't going to hurt that much if it goes bankrupt or the company does something egregious and you wake up and it's down 70%. Like a 1% position, you can handle that. Where I kind of differ a bit is the fact you've got to weigh that with like killing your upside. If you really see an opportunity, it's you kind of severely damaging the potential of that trade if you limit it to 1 or 2%. It makes a massive difference if something's a 10 bagger and you only added 1% to it. There's a 10%, like that's great, but that's not really moving the needle. And so it's important to to have enough weight that it can have a meaningful effect on the portfolio. And that's where I kind of landed my whole framework for position sizing is I usually aim for sort of 2-3% early on. So I usually aim to build that up fairly quickly, and 3% is kind of my sweet spot for before I've done a lot more work on the company. I always feel like if I really nail something and get a good multi-bagger out of it, 3% can move the needle. Like 3%, get a 10 bagger, that's 30% on the portfolio. That's meaningful. I'm happy with that, and I can still stomach 3% if it's just an absolute zero. If I completely mess it up, and so that's where I've landed over time, and with a bit more conviction, maybe I see some price action that I don't agree with, then I'll take it up to 5%, and that's kind of my max, 97% of the time. And the only time I push past 5% is if there's just a full-on liquidity crisis, and I'm just like, why am I even seeing these prices? This is just straight up ridiculous. Like I thought like a base was I don't know, down 50%, and I'm seeing like down 70, 80, 90%. And also important to note that the whole sector's focusing the same. There's nothing that the like insiders or smart money knows that I don't know. Like that would not apply if I just saw one stock getting smashed and the rest of the sector's like acting like normal. This has to be like a full-on liquidity squeeze pretty much across the broad market. Then I've in one instance I've taken the position size up to 10%. But generally, position sizing is how I really protect myself, considering I'm going into a lot of pretty shitty companies. Really, I'm going into like African miners. I'm going into like a lot of players that will dilute you a lot, and never. I've got better at sort of reading when the turnaround's happening. I've got like a whole framework now about how to avoid just sitting around getting diluted and having it go nowhere. But yeah, that's my general framework, and that's what I've found works over time. I think it's honestly really hard to answer the position sizing because there's always two things: is too much or not enough, and that's always hindsight based. Yeah. So
yeah, that's typically where I land as well. I kind of hover between that 1 to 4% basis, depending
yeah,
on how much conviction I have on something and how much potential upside it has. So I'm kind of with you there as well. So I want to take it back to gold. Gold's been rising up pretty strongly lately, making new all-time highs. Is gold trying to tell us something? The last time gold spiked this hard was, I believe, back in 2020. And gold was acting more so as a leading indicator for inflation back then than anything else. Is that what it's telling us this time around, that we are in store for wave 2 of inflation, perhaps? What do you think?
yeah, I don't think so. That's just confirming my narrative though. So I don't know if I can add anything that's non-biased to you. So the way I read it is the world slowly realizing that no one's going to buy the US debt, and so they're going to inflate it away, and everyone's just grabbing everything. They won't get inflated. Like you see you've seen it in just the unwillingness to buy US treasuries for years now, and I feel like that's kind of accelerating at the same time that US has to roll 8 trillion and issue another 2 trillion. It's the writing's now on the wall, and just doing increasingly dumb policy. Like it's from like seizing the Russian assets, like that was just it was just a like a bat signal to the rest of the developing world. Like we'll grab your money if you don't do what we say. Right up to like the latest kind of like TikTok sort of that bill getting through was like if you we'll sort of impose pretty harsh measures on sort of foreign-owned companies if we don't like what you're doing. It's just this like overstepping, and I really think that breaks the whole sort of recycling that we've seen into US assets over the last decade, and it's at a time where they should be down on their knees pleasing everyone around the world too, because they need to sell a lot of the stuff to keep the show on the road. And so I think it's everyone slowly recognizing that there's their game's going to be like print baby print, and you better start finding anything that's kind of not that is going to survive that, like just hunting out hard assets, real assets, and that's I think that's the big game. Whether some people are seeking it in crypto, which is not somewhere that I kind of feel comfortable, but I always just like simple hard assets. Like if for me, you can never build, you never beat something that's got huge replacement cost. Like a framework I've used is like it's going to be what will win in 5 years if we have a serious inflationary event will be the thing with the highest replacement cost, the biggest moat, the highest embedded energy. And so something like a drill ship that's got built at a huge cost, got built at sort of whatever it would have been, sort of probably 800 million, even a billion, then gone bankrupt with the cost to build it, acquired another few companies that have done the same. So you've just got this enormous moat, and then the people that built them all went bankrupt. So the ability to even build it moving forward is no longer there. So you just keep having a fatter and fatter moat around it. And I just want to be there once people work out that the game is inflation and that it's just this absolute bull rush for hard assets. I want to be at the scarcest asset in the world once the Fed sort of starts completely just monetizing its debt.
Yeah. So how would you play something like that? Is that something? I mean, I guess it kind of goes back to the kind of the first few questions that I asked. Is would you rather invest in the physical commodities themselves, these physical assets themselves, or in businesses that produce these assets? But given the fact that their input costs also go up as well, it kind of adds an extra layer of complexity there too.
Yeah, I've gone back and forth on this. Like taking a bath on trying to play it directly with oil futures. So um, it's very attractive sounding trade when you say it doesn't have operational risk, doesn't have political risk. You're just straight playing the commodity. But then something I kind of underappreciated at the time is just how long some of these trades. I didn't underappreciate it because I've had it in my own portfolio. I'm notorious for kind of spotting a trend, and then it always takes another few years to play out. Um, and so I I'm trying to like remove time decay from my portfolio because it just stresses me out. There's nothing that I hate more than being right on something and like getting timed out and losing money before watching it go exactly where I thought it would. Like a key example would have been uranium. Like if you'd given, I would have probably completely loaded up on uranium futures if you'd given me 2 3 years, and might not have been enough time if I kind of thought the writing was on the wall back in 1819 or even 2020. Like yeah, depends what strike and everything he'd selected could have easily not seen it to the trade, and so that's the application is quite hard in that way, whereas it's quite easy to sleep on like a coal stock that's just doing like trading at 2 times cash flow, and if the market's not going to give it any multiple expansion, it'll just attack its own share count or pay out fat dividends. So, and then everyone always jumps on royalty companies as well, saying like a cleaner expression of the like without having to worry so much about inflation. Problem with them is they're always everyone understands that, and so they inherently always trade with a pretty hefty valuation. So you don't get the upside that you do. So I do think clean commodity plays are like great, but I think everything's so cheap around the actual commodities itself that you can get some great upside and great leverage to the commodity, and that just takes more conviction and doing more homework. It's kind of like the higher volatility that comes with equities is actually an opportunity if you kind of understand the sector. It's like kind of the even Sprott physical uranium, which has been a really clean trend. And I put a few friends into that. They were like, oh, I just don't want any risk. I just wanted like a clean trade. I always thought that was like beautiful. You just owning pounds. You don't have the operational risk. Miners, you're not mining in Africa or something. That was always super attractive and super clean way to play it. But with equities, if you understand the thesis, then want to chase some names that can trade with far more volatility. And like in my case, I just wanted the biggest sitters, which I thought were the ones that had mines that were easy to restart, like the likes of Paladin, and that just traded with massive volatility in comparison to physical uranium. And so, yeah, it's stomach churning, but that's where the real performance was. And so I guess it just depends on what an investor is trying to get out of this. If they just want a nice smooth ride, then yeah, the commodities can be a great way. The straight commodities can be a great way to achieve that. And the other point with it is it's actually quite hard to find ways to execute on straight commodities as well. Like try find that with coal, try find that with tin. Like I wish there was tin futures actually. That would be far more comfortable than having to jump into DRC. Other places. Like I always joke, I'll sleep far better once I'm out of African miners. Yeah, even though when a coup or something's around the corner. So yeah, to an extent, it's a mix of both. I always say if I was rich enough, I'd love to have like a vault somewhere full of gold in a jurisdiction that I thought was safe. If I didn't have to sort of work all my money, that's probably like, yeah, hopefully get there one day that I can just sort of just park it as insurance.
Yeah. So, what's a valuable lesson that you've learned over the course of this commodity super cycle that you didn't know before?
Lots. Oh, just feel like I learn a lesson every month, usually painfully. um, Patience is number one. Like I think there's always an ability to overanalyze everything due to price action rather than just zooming out. Like making sure you have a big margin of safety with whatever you're getting into, and then zoom right out and just leave it alone. Forget so many people cause themselves so much distress by just overthinking everything, and also probably staying away from miners most of the time. Like just the amount that so they get diluted. That's like it's just a tough game. I'm forever trying to get them out of my account. Really, some commodities it's really hard to avoid them though. Um, Not minimizing time decay has probably been my biggest lesson recently. My most expensive lesson. Those are lessons that stick with you the most. Is where you have to stomach a loss. It's really internalizes it. So yeah, just having massive patience. In my portfolio, I've always got a saying that the asymmetry is usually backloaded. I've generally made all my returns generally past the 3-year mark, and that's where positions I took, I just see them really start to move, and the gains just really compound at that point. And it's kind of fascinating when you know how stomach churning would be going into the stock currently. Whereas if you've got a really low cost base, it's psychologically a lot easier as well. And yeah, that's all that's all the lessons that are coming to mind at the moment. It's probably a ton more if I sat down
Yeah.
and thought about it.
So time decay. What exactly do you mean by that? Can you go into a little bit more detail there?
So I mean by that with options. So at the time of taking an option, like 2 years can seem like a long time, but with a lot of anything based on supply demand, 2 years can go by like click of your fingers. So I kind of view 2 years as a short time now to play any of these big overarching trends. I think the shortest time frame I'd kind of consider with options now is more like 3-4 years, ideally, just so just to ensure that you're there when the sector inflects, because it's, as I said before, there's nothing more painful than spotting a trend and not being at the table when it takes off because you you got the wrong time frame. And I know Brad, my mentor, he's got around this by going after what he calls like the smaller companies that still have great optionality. So if you don't want to have any optionality in your portfolio, you can go after small companies that, like talking like microcaps, like sort of sub 200 million, that have a lot of the properties of an option without having the time decay. You could argue that in place of time decay, a lot of them have like dilution, but that's still a lot easier to handle than just straight time decay on an option. And so I've certainly gone more towards that, um, and tried to refine a whole process around trying to minimize the dilution aspect. Like you don't want to be like shippers or miners are like notorious for the share price looks like it's gone nowhere, but bring up the share count and it's just bottom left to top right. And so understanding are they starting to make $1 again? What where's the debt levels heading? Just having the framework to understand that, and then you can just have a portfolio of these that have great optionality without the time decay as such, without the stress of just watching every day a few percent sort of get eaten away. And then also the way time decay works is it's quite stressful in the last sort of third to a quarter of the option's life, because time decay really ramps up. So you really get eaten alive if the option's sort of still out of the money in the last, say, third of its life. And it's far easier to kind of select these really small companies that will really benefit from flows into the sector over long enough. You can often pull up their historic earnings and see how cyclical they are, which is kind of, I really recommend Koifin for that. It's got just the free version of it. It's got some fantastic sort of functionality for quickly analyzing a company, and you get a lot of the upside without the downside. So that's something I wish I'd kind of applied more rather than going the option route to the extent I did. Yeah.
Gotcha. So what are some concluding thoughts you want to leave us with? Yeah.
I just always think it's like, just know that you're wired wrong for investing and trading. So when anything feels good, it's feeling good for a lot of people, and that's probably the time to consider like sitting back and really assessing what you should do at that point. Like I've got like some jokes that it's like, if you ever feel like taking like a screenshot of your portfolio, that'll generally be the top in your portfolio for a year or two. And it's as simple as that, like that feeling of dopamine when you see it. You should recognize the signal
Anytime
that's
you
giving
want to
you.
brag about your portfolio,
Yep.
that's usually the top. I know it firsthand.
Exactly. And so the kind of the second level thinking that goes with that, and then that one's kind of easier to spot. The one that's harder to spot is the fact that all of like a downdraft in sort of the markets is just mass human behavior. And so it's just people's ability to hang in there getting sort of wiped out person by person. Like someone just exactly the opposite of that, just looking at their brokerage and I can't take this. And so when you start to view markets like that, it all gets a bit easier. Like if you understand, if you're going to have really high outperformance, then you have to be in that few percent that can cold-heartedly open your portfolio, see a stock's down 70% and be like, that's still great value. I'm going to buy that now. And I say that knowing that I couldn't even do that in March 20. I knew what I wanted to buy at that point. I knew the valuations and I put the orders in. And when I saw them start to get struck on my phone, I was so sick in my stomach. I wanted to open it up and cancel them and sell it again. I'm like, oh, I'm just lighting this money on fire. And so even knowing it, like I always want people to understand how easy it is to talk about the stuff when everything's fine, and how much of an emotional basket case you are going to be when it happens. And it's to understand that and try and put some buffers in between you, like silly stuff. Like one of the things Brad and I often talked about is stuff like holding, like with the IB app, hold your thumb over the account balance. If there's a big drawdown, you don't want that number in your head. If you're going in there to buy stuff, you know your cash level, you're not on margin or anything. You don't need that number in your head if it's not going to be helpful. So just hold your thumb over it. Don't see it. If it's going to prevent your psychology from doing what you need to do, and ideally, just if you're positioned well, just avoid looking at your account. That's why
That's what
I always hate.
that's what I do now. I go days,
Mm,
sometimes weeks without looking at my account.
yeah, that's the best way. It was always that. I think forget which company it was. I think it was Fidelity. They worked out which were the best who had the highest outperformance, and it was people that forgot their passwords or had died.
Yeah.
And the other side of that was, I think it was Peter Lynch's the Dallin Fund, I think it was, and they were like, "Oh, your investors must absolutely love him." He did over his career, he did annualized like high 20s, maybe 30% annualized. And when they actually analyzed all his investor base, the majority had lost money because he would run such high volatility. They'd all pile in at the top and then they'd all get fed up and jump out at the bottom. So actually, very little of his customer base was or investor base was actually trusting and having conviction in his process and riding through the downdrafts, which is just human psychology. Again, coming back to this, how badly our behavior is set up to handle markets. And so that's the hardest part of the game. The smartest people I know are often not great investors. Like, I've got friends that are like mechanical engineers and chemists and stuff, way smarter than me. And I think it's just having a very my wife says even like low sort of emotional IQ, like almost flat sometimes. that seems to really help with investing. Brad's the same. Brad's even more of a to extent to him. Like you can't wind him up. You can't ever see him get emotional. And I think that really helps. I don't know if you can train it. I'd like to think you can to some extent, but it'd be pretty hard.
Yeah, especially nowadays when you have everyone super impatient. No one wants to, everyone wants instant gratification. They want it now, 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 now. So it's really hard to not only just buy something when it's cheap, but also hold it for a decent
Mm.
amount of time.
Yeah, we're all being sort of gamified with everything. I did an experiment with one of my friends sent me through. It's like, how addicted do you think you are to your phone? And I'm like, oh, not really. Like I don't use it that much. I don't really even look at Twitter that much anymore. And he's like, okay, I'll set it over to grayscale. So just turn the phone to grayscale. And it just annoyed me so much so quickly. Like I just the lack of color, the lack of engagement whenever I open something. I was like, oh, this is really annoying. Like I lasted a week on it, and it was fascinating how much it frustrated me. And I'm not even that bad. Like I can't imagine if I got my wife to do it with Instagram. Try to, yeah. So yeah, it's how sort of even I in my last Ferg's finds I had like a 30-page write up from Vaclav Smil, like the godfather of energy, and just how like reading a great piece, it's still like it was like a dopamine hit of some interesting data every maybe 2-3 pages, and I was like wanting to pick up my phone because I assume it's because I get a more instant dopamine hit from like whether it's like I don't know, checking prices, seeing what the colors are on the price app, the forgetting what it's called, whether it's opening Twitter, whether it's opening emails, whether it's opening WhatsApp, whether it's all like all the feedback we get, and it really annoys me. Like it's affected my ability to read books, I guess, and I'm just super aware of it. That's why sort of in the process of I want to build a house in Montenegro and mountains and like turn off all the Wi-Fi and go there from a month or two every year.
Yeah, because it's only going to get worse. I mean, they're only going to get better and better at identifying points of dopamine hits and all that kind of stuff to make us even more hooked on our devices. So if you can't do it now, you're not going to be able to do it at any other time.
Yeah, when I'm thinking about it for the little guy as well, like it's he's every other parent's like, why haven't you got an iPad yet? I'm like, I'm going to resist that to the end of the day. I don't want an iPad child just sitting there, watching his cartoons. Yeah, prefer him to keep trying to buy more.
Yeah,
more
I mean, back when we were growing up, I mean, I don't know how old you are. I think you're probably around my age. I'm mid-30s, something like that.
37, yeah.
Yeah, it's like the worst thing that we had was playing too much Nintendo and watching too much TV. Like, I would take that every day over, like, what these kids today are now having to work with. Like, a lot of these new Gen Z, Gen Alpha kids, they are unable to, like, interact in public just because all they do is consume content on an iPad.
Oh, drives me nuts. Yeah, we had the rule in our house on the farm that we're not even allowed to turn the TV on during the day. We no video games or anything. And mum had like a big cowbell that she would ring for lunch, and so we'd be encouraged to go off outside, do anything outside you wanted to. I used to love playing around Dad's workshop, and I was allowed to play with Lego. Like had like Lego all over the floor in my bedroom, but yeah, no TV or screens. And I don't know how I'm gonna possibly enforce that with my son now. So yeah, I might have to set up an environment in which it just turn off the Wi-Fi for the day and can get outside as well.
Yeah,
have lots of stuff to do.
Yeah, it's going to be, I'm sure plenty of other parents are in this conundrum as well. But hey, thank you so much for coming on, Trader Ferg. Really appreciated it. Where can people find you?
Thanks for having me. This is Substack now. Is where I do 95% of my output. Yeah. So Trader Ferg at Substack.com. Yeah, excellent. I've got a weekly free email that I send out Ferg's finds if anyone wants to just get a taster.
Sounds good. Well, there you go, guys. Trader Ferg. If you have any questions, drop them down in the comments below. I'll try to answer as many as I can. Trader Ferg, thank you so much for coming on. If you enjoyed this content, be sure to give it a like. Subscribe to the channel if you haven't already so we can get more guests like Trader Ferg. And if you are interested, check out the Capitalist Exploits newsletter. We are affiliates. If you click the newsletter down below, you buy it, it does help the channel, by the way. So you can support the channel that way. And with that said, you guys, I will see you in the next episode. Bye, y'all.